Investing with a rich mentality is unique and promotes individually defined goals and success. There will never be a single asset class that can be described as the best investment for everyone. However, there are certain investments that, in general, are considered to carry a lower level of risk than others, and as a result, they provide a better place for new investors to begin. Consider participating in a retirement plan offered by your employer first before investing in something riskier like cryptocurrency, just for example. NerdWallet had an article that I'm going to go over in this video. It's 6 different types of investments that are suitable for beginners due to the relative ease and passiveness of each option. In this video, we're about to go over the top 6 best and easy investments for beginners working on their rich mentality. Number 6, investment apps. Several investing apps target beginner investors. One such service is Acorns, which automatically rounds up your purchases made with debit or credit cards that are linked to your account and invests the difference in a diversified portfolio of exchange-traded funds, ETFs. To that end, it manages your portfolio just like a robot financial advisor would, saving you the trouble. There is no minimum required to open an Acorns account, and the service will begin investing on your behalf once you have accumulated at least $5 in roundups from your debit and credit card transactions. You can also make lump sum deposits. Another app option is SoFi, which guides novice investors through the process of constructing their own portfolios by using exchange-traded funds, ETFs, and individual stocks. I highly recommend SoFi. Check out my other videos on SoFi and the link below for up to $300 for free. Welcome to Rich Mentality. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Number 5, exchange-traded funds, ETFs. ETFs function similarly to the index funds in many ways, tracking market indexes and using a passive investing strategy. They typically charge cheaper costs than mutual funds as well. You can purchase an ETF that follows a market index like the S&P 500, just like an index fund. The primary distinction between ETFs and index funds is that the former do not have a minimum investment requirement, are traded continuously, and are purchased by investors at a share price that fluctuates like stock prices. This share price, which can range from under 100 to over 300 or more depending on the fund, it is essentially the ETF's investment minimum. It used to be the case that purchasing or selling an exchange-traded fund resulted in the payment of a commission to the broker. The good news is that the majority of brokers, including those that I have listed in my description, Webull, Robinhood, SoFi, M1 Finance, no longer levy any fees or commissions for trading exchange-traded funds. If you plan to invest in an exchange-traded fund on a consistent basis, like many other investors do by scheduling automatic investments once a month or once a week, you should choose a commission-free ETF so that you are not required to pay a fee each time you buy or sell shares of the fund. Most brokers also offer fractional shares, so the entry level is as low as $1. Number 4, index funds. Like mutual funds on autopilot, index funds follow a market index rather than hiring a professional manager to construct and maintain the fund's portfolio of investments. An investment portfolio that reflects a certain segment of the market is called a market index. For example, the S&P 500 is a market index that includes the equities of about 500 of the biggest US corporations. By purchasing the companies in that index, an S&P 500 index fund would seek to replicate the performance of the S&P 500. Index funds often have lower cost ratios than mutual funds because they use a passive strategy to investing that involves tracking a market index rather than using professional portfolio management. Investors in index funds, however, purchase a portion of the market at once, similar to those who invest in mutual funds. There may be a minimum investment requirement for index funds, however some brokerage houses like Fidelity and Charles Schwab provide a variety of index funds with no such need. This means that for less than $100, you may start investing in an index fund. Number 3, target date mutual funds. Although they are still widely utilized and immensely popular, especially in popular retirement plans, these are somewhat reminiscent of the robo-advisors of the past. Mutual funds with a target date are retirement investments that automatically make investments based on your anticipated retirement year. Let's take a step back and define what a mutual fund is, which is effectively a collection of investments. When an investor purchases a share of the fund, they simultaneously invest all of the fund's assets. Although the fund's investments are normally made by a professional manager, there will be some form of overarching theme. A U.S. equity mutual fund, for instance, will invest in U.S. stocks, also called equities. In a target date mutual fund, equities and bonds are frequently mixed. You may select a target date fund with the years 2050 or 2055 in the name if you intend to retire in 30 years. Since your retirement date is far off and stock returns often outperform other investment types, over the long term, that fund will initially carry primarily equities. It will gradually move part of your funds towards bonds over time in accordance with the basic rule that you should take a little less risk as you get closer to retirement. Number 2, a robo-advisor. You have managed to put together a small amount of money to invest, even though you are aware that you should, but you would much rather wash your hands of the whole thing. The good news is that you can, in large part, because of robo-advisors. These services use computer algorithms to manage your investments on your behalf. A robo-advisor typically has fees of 0.25% to 0.5% of your account balance per year, and many of them let you start an account with no minimum due to their minimal overhead compared to human investment managers. They're a terrific option for novice investors to get started because they frequently require very little capital and take care of the majority of the job. While a robo-advisor will handle the grunt work, you should still keep an eye on your account because it is your money and you should never be fully hands-off. Additionally, robo-advisors can assist you if you're interested in learning how to invest but need little assistance getting started. It's helpful to understand how the service creates a portfolio and the types of investments it makes. Some services also provide instructional tools and information, and even a few let you slightly tweak your portfolio in case you decide to try some new things in the future. SoFi has similar options to this. Overall, robo-advisors is the least recommended thing for me personally. Number 1, a 401k or other employer retirement plan. If your employer offers a 401k or some other type of retirement plan, you should probably put the majority of your money into that first. This is especially true if your employer will match a portion of the payments you make. This match will provide you with both free money and a return on your investment that is guaranteed. You can begin by donating as little as 1% of each paycheck. However, it is recommended that you seek to contribute at least as much as your company will match in order to maximize your potential rewards. For instance, a common matching plan is for the employer to pay half of the first 6% of an employee's income that the employee contributes. You would have to make an annual contribution equal to 6% of your salary in order to qualify for the full match in that situation. But with practice and effort, you can eventually reach that level. If you choose to put money into a 401k, that money will come straight out of your paycheck and be deposited into the account rather than being sent to your bank first. Most 401k contributions are pre-tax. There are a few 401k plans available today that will automatically invest your money in a target date fund. But you may also have access to alternative investment options. I just want to reiterate real quick on the pre-tax benefit here. That is 6% of your annual income each year you won't be paying taxes on. Slow and steady is the name of the game here. You want to plan in decades, but live in the moment. Having high EQ, emotional intelligence, will help you live in the present and not make it all about money, but still set yourself and family up with wealth in your future and their future generations. 20-year minimum investing goals will keep the mind calm, and you won't worry much about dips and recessions like the one we're in now. With each video you watch here on this channel, you'll become more and more comfortable with the rich mentality, so stick around. Thank you for watching.